Hello, Joint Outs fans. Bob Scott here with Jimmy Vreeland. We got a special guest here for you today. Aaron Chapman is one of our lenders for turnkey deals, and this guy specializes in investment loans. He's got some of the best rates, some of the best loan programs we've ever found. So we're really excited to have him on here today to explain the great terms that he has to offer and how exactly he's able to offer these type of programs.
And the great terms, Aaron, correct me if I'm wrong, it's 30-year fixed at 5%.
30-year fixed in the fives, yes. We had last year up until, I would say, the beginning of November, we were as low as 4.75% for a 30-year fixed, 20% down deal for an investor. It bumped up as high as 5.5% after the elections, but it's working its way back down. You know, the election had a lot of impact on the market. The anticipation was if Hillary got in, we might see a little bit of an impact to the negative on the rate, maybe an eighth of a percent. And then if Donald Trump had won the election, we'd see this major decrease in interest rate. It completely went opposite direction where they thought it would go. Donald Trump's becoming the president-elect completely threw everything to a tailspin. So it spiked up to about 5.25%. And then Janet Yellen came in and started talking about what they're going to do next year with the interest rates, and it spiked again up to 5.5%. But market's been recovering. We've seen a lot come back since then. So I've seen a lot of deals locking in close to the 5 1/8 range, maybe 5% on occasion, depending on what's going on each day in the market.
If I was a turnkey buyer, the thing that would bother me the most would be balloon payment. So getting that 30-year fixed, I think is incredible.
Oh, I agree. I mean, you don't know what the future is going to bring, and to be able to have a payment you can count on, know it's going to be regardless of what happens, especially when we're talking about, you're in a business where you're counting on somebody to occupy that piece of real estate. We know that, the best case scenario, it's occupied 100% of the time. In those situations where it's, you got 25% of the time might be vacant, you at least have budgeted within your business strategy how to cover that and not have to worry about something coming down on you down the road when things may have changed in your business. You may not have the capital to retire that debt. And let me qualify something there. We talked debt, and I don't really look at this as debt. I mean, when you're talking about financing with a bank, a lot of people from a consumer perspective look at it as they're going into debt. You're really taking on a business partner. You're taking on a business partner that is willing to put up 80% of the capital for your business, either expansion or acquisition, but they don't want 80% of the ownership like a normal partner would. They want, say, 5% or 5 1/8% of their 80% in 12 installments every year, and they leave you alone. And once that property or that business is worth its most and it's cash flowing at its highest, where's your business partner? They're paid off and they're gone. And who paid them off? The person utilizing the asset, yet they paid them. You grew in value as far as your business was concerned, expanded on your earnings on it, and you got to write off the expenses if you paid it. I mean, it's a win-win across the board.
Well, really, the tenant pays it down.
Yeah, exactly. Because they're occupying, they're using it, they're paying the payment on it for you in essence with their lease agreement, and you're taking the delta on it. I mean, it's a phenomenal process that really works out in the favor of the investor more so than anybody.
And so, just so everybody knows, like us as investors with 120 some odd properties, we can't get access to this type of financing.
Unfortunately not, until, because what we're talking about here, this money that we're utilizing, that they call conventional money or conforming money that comes through Fannie Mae and Freddie Mac, it's not their money. It's not bank money. This is Wall Street investment capital that comes really from pension funds. There's somebody out there with a pension that's retired that's funding your business. They're expecting some sort of return, but they also they want to limit their risk, right? They don't want their risk to be out there with somebody who's stretched out for 100 properties. That if something goes wrong in your life, that's 100 properties come toppling down. That's a lot of money tied up in one basket. Now, they're willing to do 10, and I hear there's talks of them expanding beyond that, whether or not there's some real anticipation there. In fact, you guys were present at that meeting where they talked about going beyond 10 when we met in Colorado. So we'll see what ends up happening. But right now, it's extremely sweet money for those who want to get on utilizing that. Now, going beyond our strategies we try to employ with each investor as we talk to them and as we look at their finances, we may close the loan, but that's not our business. Our business is business strategy, helping them to structure their finances in a way to make them eligible for as many finance properties as they can get, and then strategize beyond that. How we generate revenue is by closing these loans. That's where our revenue comes from. So we're not having to charge them an hourly rate like a CPA or an attorney to help them strategize a business. We focus on making their business successful, so I don't have to worry about mine and yours. You guys don't have to worry about your business as long as we're focusing on the business that we're working with.
Right.
And let me do one thing real quick here for those who want to check out and see what states I work in. I'd say go to the NMLS, the consumer site online, and that's the Nationwide Mortgage Licensing System. My NMLS ID number is 2678844. You can plug that in as a consumer and look and see all the licenses I carry and know if you're looking at a specific state, whether or not I'm licensed in that state. There's 23 different ones, and it's easier to just look it up than it is to rattle them off, because if I'm trying to rattle off the top of my head, I wouldn't be able to get them all.
And so you have to be licensed in Missouri to land on a property in Missouri?
Correct.
Okay.
Correct. And I am licensed in the state of Missouri. I do a lot of business out there in Missouri.
Cool. And then what is the name of your company? We might have jumped ahead a little too fast.
But I'm a Security National Mortgage Company. This is a firm that I hang my licenses with. I'm not a principal nor an owner. I am a licensed mortgage loan originator within the organization. And so, yeah, we are out of Utah. That's where the corporate headquarters are. And I'm housed in Arizona.
Okay. And we'll put your website and all your information on the video.
Yeah, they go right to the website and check it all out.
And so why isn't every other lender in the country offering what you're offering? Because everybody's going to see this video and be like, no way, nobody's offering these terms.
There is a lot of lenders that have access to this. It's just whether or not they want to. It's a lot of work to get this built. So most people, let's talk about most individuals that are in business. It's a transactional relationship, right? Like walking into a store, paying your cash, they run it through the register, you walk out, transaction's done. Relationship ended. Now and again, you get to a point where you know the owner of a business, you become friends, and they'll give you a little bit of a discount because you're a repeat customer and you built that relationship. That's not traditional anymore. We live in an environment where everything is very transactional. It's a very consumer-based economy, right? 72% of the U.S. GDP, from last I saw, at least that's the last statistic, is based on consumption. So because of that, people advertise in a way to just churn people through. So when we're talking about an investor coming to them to buy a property at, say, $65,000, they're financing a small amount. 80% of 65 is a pretty low loan amount. Most banks are going to look at that and say, that's too expensive for us to take on. It costs us more to manufacture than we make on that. So they kind of limit their access to that. I'm not saying that's everybody. I know that that's a thought process of many. Mm-hmm. So because of that, the relationship's never really formed. Well, I saw an opportunity there back in 2003. I've been in this business since 1997. 2003, I started seeing this opportunity with investors to build that relationship, help them build their business. In reality, they don't just deal with one transaction. It's 2, 3, 4, 5, 10. Then they start, we strategize how to pay down some of those. They come back and do 12, 13, 14. I mean, there's some clients I've seen 42 properties that we've done, and it's because of the relationship piece of it. We structure it once and then continue to recycle it over and over again. The other thing is when you consider the risk associated with it, right? We referenced before the pension funds, that they structure the financing for this based upon risk. Many banks look at it to be very risky to have more than 4 finance properties with one person, right?
Right.
That is a lot of eggs in one basket. And I get that because they're a big global entity. They make the money off checking accounts and savings accounts and financing cars and doing credit cards. This is kind of like a offshoot business to help them just add to their income, but they don't want to dig in and do so many with one person. Well, that's why when I started searching around and finding a firm that would accept that, Security National is one that jumps in and enjoys it and does this. They understand it. So taking on 10 finance properties with an investor for us is actually really good business because we know the structure of what they're trying to do. This is a cash flowing business. This is not a situation where they're trying to go, trying to pull money back out. You guys remember the movie The Big Short?
Yeah, these aren't ninja loans, right? These are people with W-2s, high income earners that are just trying to leverage their W-2 at this point, right?
Correct. In that, and also there's a lot of owner-occupied, self-employed people. I do a lot of that. There's people that I've done loans for that are strictly, their income strictly from real estate investments. We've done a lot of that as well. So it can be done for all walks of life. We have to make sure their income is good, their debt structure. is well within line of what their income is, at least their verifiable income off their taxes, and make it work. Where it's a matter of just understanding the individual and being able to structure around that within the programs available. Many of those programs are available to many banks, but they just choose not to dig into them very deep.
And what's the minimum credit score you work with?
680 for investments.
680.
Yeah.
What about for owner occupant?
Owner occupied, I've seen things go down as low as 600 for government type loans.
Okay.
600, 620, somewhere in there. So that cover the question as far as why we do it versus somebody else. Yeah. I think there's a lot of other people that can do it. It's just whether or not they choose to.
Right, because I know the first objection we'll get from our investors is like, no way. Why isn't everybody doing this? Because that's the first objection we get when we sell life insurance.
Yeah, and we run into that too. A lot of people ask me, well, how is it you're able to do that and other people aren't? Because it just sounds a little too big to be true that I can put 20% down and get nearly 5% interest rate and it's 30 years fixed. Well, the program exists. It's all dependent upon where you're going and what people's focus is. It's not easy business. This is difficult business. When I tell people, when I have that first conversation with them, I explain to them, you're getting ready to go through a very miserable experience, getting started and building this up. But you do have a choice in this to work with miserable people, right? Yeah. So we had that first conversation to determine whether or not we have a basis to do business together. Because if my philosophy on business, when it comes to acting kind of like the CFO of their little investment firm, you guys are acting like their COOs, the operations division, they as a CEO of their little investment business needs to decide who's going to fill those roles. And if we can fill that for them, that's where we start moving forward. But if they believe that my philosophy on this is not right, then they need to move to somebody else so they believe the philosophy is correct. Right. Because the money's out there. They can find it. They can get it, but it just depends on who they want to work with to get it.
And that's why.
And sometimes they'd have to convince the other banks to do it because they just don't really want to. It's a lot of work. It's a ton of work.
And the reason we like working with you is because you have so much experience with investors. You understand the investment mindset and what people are trying to accomplish. And if they went to a lender, down the block in their local town, that guy's really not going to understand the ins and outs of investment property and the whys behind what we're trying to accomplish. Would you mind walking us through a typical transaction for people that maybe have not bought a property in a while or maybe looking at funneling some investment capital from stocks into real estate? What a typical timeline looks for. Let's say they put a property under contract. What kind of documentation do they need? What's the conversation look like with you? And just those kind of steps.
Well, let's start that from the onset. Typically, from you guys, we get that referral email that says, hey, Aaron, meet so-and-so, so-and-so meet Aaron. They're looking at getting some investment real estate. Then we'll reply back attempting to schedule a call. In that attempt, the reason I want to do it that way is so we have that opportunity to converse and find out what their future looks like to them. Let's write the final page in your investment book, and let's write it backwards to the table of contents. Then we'll also give them information to be able to apply online. The reason we want them to apply online is it allows them to complete some acknowledgments that the government requires that we have done so we can legally work on their transaction. Then they're able to download some data to me so I can import that, review it, and get like a 10,000-foot flyover on their finances. And then have an additional conversation after that about all the details that we have and start setting them up for what is the next step. Do they want to buy one? Do they want to buy 10? Do they want to buy 2 or 3? And then at least explore how they want to set their business up and give them pointers on what to do and protect them from maybe steps that somebody else may have told them that they should be doing that may cause them some problem. Once that's completed and then they find a property that makes sense, we'll issue them a letter that tells them you go ahead and purchase some property and here's how many properties we reasonably believe that you could finance. And then they go out and make those purchases, get into contract. That's when the real heavy work starts. We'll start verifying a lot of details about that contract. The next step is to order an appraisal. We have to verify the value of that property and that what they're buying is worth what they're paying. Also, within the appraisal, we verify what it will rent for. Even though somebody might believe it will rent for, say, $1,000 a month, the appraiser is going to do an analysis of the market, say for sure whether or not that makes sense. The cool thing about that is, even if the property is not leased at that point, I can take what the appraiser claims was the potential rents on it as income for the person buying it to help them qualify, right? So let's just say that they're the property is $1,000, is going to cost them $600 a month between the total payment between the principal, interest, taxes, and insurance. But it'll rent for $1,000. I'll calculate 75% of that potential rent being $750. Then I'll back out the expense of $600. Then I basically take that $150 delta and I add it to their income. Their debt to income ratio just got better by buying that property.
Awesome. So that's
another unique thing that we have that most lenders don't have available to them, because in their mind, they're starting up a new business, therefore they should have a 2-year history of ownership. We're able to use that to benefit. So the next step after the appraisal comes in, we would have ordered title in the process. We review title, make sure everything's clear on that. We send it on to our underwriting department to approve it, which takes about 24 to 48 hours. If everything's clear on it, we move on to closing. If it's not, we go and chase additional data, which may take another 2-3 days. Go back in, get that clear to close, send it on to closing. Then some other timelines kick in. The closing department will issue what's called a closing disclosure. The buyer needs to look at that, acknowledge it. The fees may not be 100% accurate. It's just what we know at that time. Then once they sign that, a 3-day waiting period starts. Once that waiting period starts, that's required by the federal government. The title company will then shore up all the fees to be exact. They have to do some of the prorations with respect to the taxes and insurance, and they have that exact number sent out with our closing documents for the buyer to sign. 9 times out of 10, we have them sign with a mobile notary at their home or Starbucks or at their office. So that way they don't have to be present to do that. We'll have somebody else come to them. They ship that back, we refund within 24 hours of that, and they now own a piece of real estate. Now, the one thing that takes the longest, it's usually about a 40-day process. What usually takes the longest is the appraisal process. We have way too much business and way too few appraisers out there in this world right now. It's very hard to become an appraiser. It's hard to expand and do appraisals right now, so it takes a long time to get them scheduled. Some markets I've seen them take 6 weeks. Other markets they take 1 to 2. But it all depends upon the amount of volume of business at the time. So we just ask for patience in that. We don't have control over that.
Okay. So what's the fastest if you've got a sales contract? What's the fastest you've seen it be funded and have the deal done?
Fastest I've closed one here within SNMC with all those steps being taken care of, and that was everything working like clockwork was just under 20 days.
Okay. What's the longest?
I've seen it take a couple of months.
And what's average, you think?
Average about 40.
Okay. Cool.
Great. And then one other thing I wanted to clarify: if someone has an LLC, can they use this loan program, or does it have to be in their personal name?
This is personal name stuff.
Okay.
Because the LLC, then you're talking about financing an LLC. That's a commercial loan. As you start getting into the 20-year amortization, 10-year call, that kind of stuff. This is definitely for your personal assets. You can use trusts to hold the asset in. We close a lot of these transactions in a person's personal trust. So, the Garn St. Germain Act, put it out there where a person can put any property in the name of their living revocable trust, and they have the capability to rent that. And so that's utilized quite a bit as that asset protection, if you will.
Great. Awesome.
And do you have some education for potential investors for that sort of system using the trust?
What we try and do is just have a really detailed conversation about what their intentions are, give them the long and the short of where they should, the different things that I've seen investors do successfully, and it's all based upon experience. Because trying to give an educational piece out there for such a broad range of people's financial structures is difficult. Because even though it seems like it should be streamlined, it should be something we can make a simple path towards. Everybody's situation is vastly different, so we need to tailor it to that individual. So I like to really dig deep for that one-off scenario with each person.
Okay.
Awesome.
You got any other questions, Bob?
No, I think that about covers it. Thanks for your time. Do you have any other closing thoughts? Anything people should know about your program or working with you?
Well, the main thing is just setting up the time to talk. And the one thing I really want to encourage is let's in as initial email schedule that time where we can block about an hour. I've seen some conversations take 10 minutes, some conversations go an hour and a half. If we block an hour out, we can really dig deep into the details of what's necessary to make this work. And scheduling the appointment is always the best thing to do. So that way I can, like right now, I can just set the time aside and we can have this conversation. If it's trying to field a call that just comes in off the cuff, I could have a full day scheduled of 20 conference calls and various different emails coming in at any given time. So we really want to be sure that we schedule that time and block it out for them. then also encourage people, go to the website, aaronbchapman.com. Go to the NMLS, confirm which states I'm in. Know for a fact that I am who I say I am. I have those 23 licenses. I am a licensed MLO, that you're not working with somebody that maybe is pitching some things out there and you're hoping it works out.
Cool. Well, thanks for your time, Aaron.
Thank you, gentlemen. It's always good to chat with you.